I see Aussie investors online arguing low fees versus high fees, Vanguard versus BetaShares, 0.07% versus 0.5%. And while everyone's fighting over a few basis points, they're completely missing the point. Because I've seen investors with the cheapest ETFs on the ASX make zero money. And I've seen investors paying 0.6% in fees absolutely crush it with 30 to 40% return. The answer isn't always low fees, and it's not always high fees either. It's knowing when, why, and where each option makes sense. In this video, I'm going to show you the lowest fee ETFs across gold, global tech, dividends, the NASDAQ, China, and AI. But more importantly, I'm going to break down my exact decision-making framework, when to go cheap and when it's worth paying more, and how I personally allocate these ETFs in my portfolio. Because at the end of the day, it's not about saving 0.2% in fees, it's about building a portfolio that actually makes money. Part 1, how ETF fees actually work. Now, before we look at the lowest fee ETFs, you need to understand how the fees actually work. So let's talk about the MER, the Management Expense Ratio. This is the annual fee that the fund charges you. It's shown as a percentage and it's deducted from the fund's net asset value every single day. So you don't see it as a separate bill, it just quietly eats away at your return. For example, if you've got $10,000 invested in an ETF with a 0.5% fee, that's about $50 per year. Doesn't sound like much, but over 20 years, an initial $100,000 growing at 8% gross would become around $462,000 with a 0.04% fee. But at a 1% fee, you're looking at around $387,000. That's a difference of $75,000. So fees do matter. But there are other costs you need to consider. There's the bid-ask spread. That's the difference between the buying and selling price when you trade on the ASX. For highly liquid ETFs, this might be 0.05%, but for less traded funds, it can be a few tenths of a percent every time you buy and sell. Then you've got brokerage fees. That's what you pay your broker every time you make a trade. Unless you're using a platform with free ETF trades, this is another cost to factor in. And for international ETFs, there can be currency conversion costs and foreign withholding taxes on dividends. So when we talk about low fee ETFs, we're mainly talking about the MER, the management cost. But just keep in mind that's not the only cost. Part 2, my rule of thumb for fees. Now here's my take on fees. If you saw my last retirement video, you'll see I use the core and satellite approach. Your core, about 70-85% of your portfolio, should sit in one low-cost diversified ETF. That's your anchor, the stable part that compounds quietly in the background. Then you've got your satellites, the remaining 15 to 30%. This is where you add targeted themes like Asia, healthcare, gold, dividends, whatever you want to tilt toward for extra growth or income. Now for your core part of your portfolio, you want to keep fees as low as possible. We're talking under 10 basis points if you can, because these are the long-term holds and higher fees add up over time. But for satellites, I'm willing to pay a bit more if the exposure is exactly what I want. These aren't 20-year positions. Fees matter most over long time frames. If I'm holding a gold ETF for 20 years, yeah, I want the cheapest one. But if I'm holding a China tech ETF for 12 months to capitalize on a trend, I'm not stressing about paying 0.45% versus 0.35%. For example, DRGN China Tech ETF, which we first covered in the newsletter on 20th of July 2025, returned 35% over 2.5 months. For returns like that, I'm happy to pay a 0.45% management fee. It's all about the strategy. Part 3, lowest fee ETFs by theme. All right, so now that you understand how fees work, let me show you the absolute cheapest ETFs on the ASX across the most popular themes. Let's start with gold. Gold remains a popular hedge for Aussie investors, and the fee differences between ASX-listed gold ETFs can really stack up over time. At the low end, you've got GXLD and PM Gold, both around 0.15% per year. GXLD is a straightforward, physically backed bullion ETF that simply tracks the gold price. PM Gold is backed by the Perth Mint, fully supported by the WA government, and gives exposure to gold stored in their vaults. A small step up is GLDN at 0.18%, a physically backed iShares fund with solid liquidity. Then costs start to rise. Gold comes in at 0.4%, which holds physical gold but charges a much higher fee for similar exposure. And at the top end is GDX at 0.53%, a VanEck fund that focuses on gold mining companies, and QAU at 0.59%, a currency hedged option aimed at reducing the currency swings. So over a 20-year horizon, the gap between 0.15% and 0.4% compounds significantly. If you want simple, low-cost gold exposure, GXLD and PM Gold are still the clear winners. Now let's talk global tech. Tech ETFs have been some of the best performers over the last few years, but they also tend to have higher fees because they're more specialized. The lowest fee global tech ETF on the ASX from our list is the Global X FANG Plus ETF at just 0.35% per year. It tracks the NYSE FANG Plus index, mega cap leaders like Apple, Amazon, Nvidia, and Meta, and at 0.35% is noticeably cheaper than most other tech options. Most thematic tech ETFs like cloud computing, semiconductors, AI, or cybersecurity sit between 0.45% and 0.7% based on the table to my left. So if you want broad exposure to the lowest possible cost, FANG stands out as the cheapest option in the category. And if you want funds focused on specific sectors in tech, then the fees start to get a bit higher. Next, dividend ETFs. Dividend ETFs are popular with the Aussie income investors, and fees across the category are generally pretty reasonable. The cheapest option is SYI, the SPDR MSCI Australia Select High Dividend Yield ETF, with an MER of just 0.2%. Compare that to IHD at 0.23 or Vanguard's VHY at 0.25%. Now that's a difference between 0.2% and 0.25%. Doesn't sound like much, but SYI has also been a consistently competitive performer in the category. So you're getting low fees plus strong, reliable performance, which is exactly what you want in a dividend ETF. Then lower down the list, there's actively managed and yield maximizing ETFs. These won't be relevant to most people watching. If you're interested, I recommend doing your own research. Now for NASDAQ Index ETF. If you're looking for the standard NASDAQ 100 index tracking ETF on the ASX, the main option is BetaShares NDQ. It charges 0.48% per year, which is higher than the US listed QQQ at 0.2%. But NDQ is Australian domiciled, no US estate tax issues, no W8 BEN forms, and you can trade it in Aussie dollars on the ASX. So you're paying a bit more for that convenience, but for most Aussie investors, it's worth it. There's also a hedge version, HNDQ at 0.51% if you want to remove currency risk, plus an equal weight option, QNDQ at 0.48%, if you prefer a more balanced approach to the index. Now, there are other NASDAQ-related ETFs on the ASX, covered call income, QYLD, and leveraged long and short products, LNAS and SNAS. But for the pure traditional NASDAQ 100 exposure, NDQ is the go-to choice. China equity ETFs. China ETFs have been interesting lately. China's market has had its ups and downs, but there's still a lot of interest from Aussie investors. Among the China-focused options, the lowest fee pure China funds on the ASX are CETF and IZZ, both at 0.6%. CETF tracks China's large cap A shares, while IZZ focuses on major offshore listed Chinese companies. If you're looking for broader regional exposure with China as a major component, IAA comes in even cheaper at 0.29% and VAE at 0.4%, though they're not China only. And for investors who specifically want China exposure, CETF and IZZ are currently the lowest cost choices. And finally, AI, the hottest theme right now. The three core AI ETFs, AINF, GXAI, and RBTZ, all charge the same fee, 0.57%, so there's no cost advantage between them. Your choice really comes down to the index and how pure you want your AI exposure. The only outlier is Robo at 0.69%, mainly because it tracks a more specialized robotics and automation index. And while these fees are higher than broad market ETFs, they're pretty normal for a niche thematic like AI. Now, I track all these ETFs every week in my newsletter. I show you which themes are shifting from base to trend, and I share my model portfolio. That's up 13.71% over the past 6 months, compared to the ASX at just 3.98%. The link is in the description, and the first 28 days are completely free. Part 4. Why the lowest fee isn't always the best. All right, so now you know the cheapest ETFs in each category. But everything I just showed you is completely useless if you don't understand this one thing. The lowest fee doesn't always mean the best investment. ETFs don't just move up and down randomly. They move in what I call a base and trend pattern. You'll have a base where the ETF is just chopping around, not going anywhere. And then something changes and it starts to trend. That's where the money is made. Now you can have the cheapest ETF in the world, But if it's sitting in a base for 3 years, you're not making any money. In fact, after fees and inflation, you're probably going backwards. But if you've got an ETF with a slightly higher fee, say 0.5% instead of 0.1%, and it's in a strong uptrend, you could be making 20, 30, 50% returns. So which would you rather have? ETF that saves you 0.4% in fees but makes you nothing? Or the one that costs a little bit more but actually delivers returns? This is why I say fees matter most for your core holdings. If you're buying VAS or IVV, broad market index funds that you're going to hold for 20 years, yeah, get the cheapest one. Every 0.05% matters over that time frame. But for your satellite holdings, those thematic plays, those sector bets, I'm much more focused on the trend than the fee. And that's what I focus on in my newsletter. Click the link below and I'll see you in the next one. And don't forget to follow the trend.